Okay, welcome everyone to IP Global's Intelligent Property Investor Series. Over the course of the next few months, our property experts will provide you with the educational insights that have helped thousands of investors across the globe make smarter decisions. This is our first episode, and it will expose some of the hard truths about property investment. As many of you know, it's not always smooth sailing, and there's a lot of noise in the market about exceptionally high yields and rental guarantees that isn't always accurate. Now, we make no claims to be perfect and have made mistakes along the way, but having learned from this, one thing IP Global does differently is consistently outperform our average projections year on year. We don't make false promises, and we pride ourselves on transparency as a core value that the whole organization sticks by. So without further ado, let me introduce you to our experts that will be hosting you for the rest of the webinar. Director of Wealth Management with 20 years of experience in the US, Europe, and Asia Pacific markets, Jonathan Gordon. And then we also have the Head of Wealth Management for the UAE and Southern Africa region with 15 years of experience advising for major industry players, William Page.
So before we jump on and talk about the agenda today, just a very quick run through a little bit about who IP Global are. We saw the registration list before. There's certainly a lot of new faces on the call, as well as some very loyal and friendly clients of ours. So, but just quickly, I mean, we're a property advisory company, clearly, and we're helping clients invest in property intelligently, you know, throughout different markets around the world. So that was our goal, and that was our mission, and we started this mission in 2000, all the way back in 2005. The next slide will just detail a little bit about what we've been up to. So we've invested in over 18 different countries. That's a total of over $3 billion worth of money invested on behalf of our clients now, and well over 5,500 sort of units, apartments sold. So, you know, we've been around a long time. We know what we're doing, and we've had some great success along the way, and we've had a lot of fun along the way. So that's a little bit about where we've been and what we've been up to on our journey. And then, you know, how do we actually operate? Just very quickly, I don't want to go on for too long on this, but effectively we're clearly very heavily research driven. And then on the back of the research that we undertake, you know, we look to bring opportunities to market for our clients and manage that whole process right from A to Z, in terms of helping clients with the legal side of that purchase, helping clients with obtaining a mortgage on that property perhaps, and then of course getting that property to be income generating, getting a tenant in that property and collecting that rental for you, which we do all through our sister companies, you know, all part of the IP Global umbrella. And how we actually go about sourcing the opportunities is really our key USP. And we were the first company, and still one of the very, very few companies that actually do this. We co-invest into the projects that we bring to market. So I think an example is the best way to explain this. Let's say that our research team have identified Germany as a country that we see a lot of stability in and a lot of potential for growth. Perhaps we like Berlin. And then there's particular suburbs of Berlin, obviously, that are more attractive than others. And that's our job to bring those best opportunities to you as investors. Now, we won't just find that opportunity and bring it to market. What we'll traditionally do is actually underwrite the scheme. So a developer's building 100 units in a good area of Berlin. We approach that developer as the project is being built, and we will actually bulk purchase potentially the whole project from them. So we offer developers a very clean exit, and we're able to drive great pricing and pass on great pricing to our investors by underwriting. So we've got skin in the game is the term there. And we're very much aligned to completions, because completions is where our clients will make money. It's where we make our money. And we have that moral obligation, of course, because we're good people, but we're also financially invested into the completion of the project. So just some key points there before we move on, and I'm going to hand over now to Johnny to pick up the first slide, which you can see on the next one, please, Sylvia. You can see there we've got the 10 topics that we're going to cover today. We won't be too long. We'll keep things moving pretty quickly, and obviously Johnny's going to pick up slide number 1, which is the next one, please, Sylvia.
Okay, thanks, Will. Good morning, good afternoon, good evening, everybody, wherever you are. I was told there's about 500 people on today, so clearly there's some interest in some of the topics that we're talking about, so hopefully we'll keep you engaged throughout. The first thing that I wanted to talk about, and the challenge that we come across all the time as far as property is concerned, or property investment is concerned, is removing emotion from the equation. What I mean by that is actually removing emotion from the decision making. I think one of the main challenges as far as property investment is concerned is that people do tend to get emotive about what they're choosing, where they're choosing. And if you think about the other investment classes out there, stocks or shares or commodities, none of that is the case. I mean, you're buying commodities based on the price and where you think it's going to go. You're buying an equity based on the dividend or potentially what the P ratio is in relation to other shares in that asset class. And property should be the same, really, because you're not going to buy it. You're not going to live in it in most cases, as far as investment property is concerned. And really, it's a case of focusing on the fundamentals as to, where you think you're going to make some money. And I guess slightly counterintuitively, the best places to invest are not necessarily the nicest places. These are the areas undergoing the regeneration, the improvement of infrastructure that we'll talk about shortly. But ultimately, it's sometimes difficult, isn't it, to make those decisions to invest in areas that maybe you wouldn't want to live in, or someone that lives there and maybe they've not had a good experience, but ultimately you're looking at 5-10 years time as to how that area is going to look at that point. If I think back to some of the areas that we've invested in over the years, they weren't particularly smart to begin with 10 years ago. Parts of London, for example, parts of Hong Kong, if you're a private investor, but no question they're the ones that perform the best if you can just get over that point that if you take away the emotion, it's really about the fundamentals, supply, demand, improvements, infrastructure, etc. So that's what I would say on that slide. Will, over to you.
Thanks, John. I think that covers it really well. I think time and time again, we see people trying to sort of combine a property investment with maybe the requirement that they want a family home in the West Country of England or something. And I think the challenge is that's not ultimately the best way to invest your money. It's unemotional investment that we're looking to help clients make.
Yeah, I mean, the other one is, the classic one is when you go on holiday to a place, you think, oh, I wouldn't mind investing there, but a holiday resort type destination and investment are two very different things. So again, try and think about these things objectively is what we're trying to say.
Absolutely. And then when doing that, you're able to, now we're onto this slide here that I'll just pick this up. So this is the Bible. You need to stick to these 5 core principles. And time again, we see people miss a few of these. And our investment team are always making sure that all the markets and all the opportunities that we secure, that all these boxes are ticked. And as I said, time and time again, I mean, I'm based in Dubai at the moment, in the Middle East, and it's a wonderful place to live. But ultimately, that first tick box potentially is missed with the amount of supply that has come to the market in the last few years. And time again, we see people make those mistakes. So you always, of course, want to buy in an area that's seeing population growth, that's seeing wage inflation, because ultimately that's going to put pressure on the housing market, and people can afford to pay more for those houses. And as Johnny's mentioned, getting into infrastructure projects, getting into gentrifying and regenerating areas, this is absolutely key to making money ultimately through property investment. And just to show you, this was a market, this was an area of, some of you may know, Islington in London, sort of on the city fringe of London, and an area that was, I remember back in the day, talking to clients about this back in 2009, 2010 as an area to invest in, and we had a lot of objections, but you can see that the clients that were brave and bold and put their money into this up and coming fringe area of the City of London have made staggering returns. As per the data here from Land Registry, you can see how much growth has been seen in this particular borough of London. So you can see on the next slide, please, Sylvia, just a couple of example projects, and Pegaso building, one of our early schemes in 2009, hugely up in value now since our clients invested there, and the same with Elmore Street. And Johnny, I'm sure you can recall that there were, it was, I remember sort of talking to clients who were objecting about these areas because of what it was like there at the time, and you know, you can see how much returns we've made there.
Yeah, definitely.
Next slide, please, Sylvia.
All right, so this is on to me, and this is to do with taking debt. You know, a lot of people may think that having debt is a bad thing, and I would question that. I would say some debt is good, too much debt is bad, and also the type of debt that you have as well. I'm certainly not subscribing to getting too much credit card debt, that sort of stuff. But if banks are willing to structure loans to you at cheap rates to buy property, then that's worth looking at. And the whole concept of leverage returns is how people become truly wealthy, building up property portfolios rather than just paying cash. And if again, not trying to get too much into the detail here, but if we combine or compare two examples, a cash purchaser who's investor A who puts down £250,000 of cash, and let's assume 5% in round terms increase for 6 years, the apartment after that time has gone up by £75,000. And so the total profit, if you combine the rent as well, the return on investment is about 60%, so 58.8% in rough terms. Now, I absolutely realise that I haven't put in transaction costs and taxes, so we're just trying to keep things simple here. But you can see that by putting my cash into the market, I get a 60% return with a combination of rental yield and also capital growth. Now, investor B takes a slightly different approach and puts down a 30% deposit and takes out a 70% mortgage. He or she has the same appreciation of 5% for 6 years, pays 4% interest, which I think is fairly reasonable at the moment. You could probably in the UK actually get it for less, but let's assume 4. And that you have the same appreciation in capital terms. But then the key difference is that if you look at the bottom, that investor has effectively doubled his or her money because they put in 75 and have taken out double that. Now, the point there is that starting off with the same amount of cash, you could actually buy 2-3 properties and have that element of growth on the 2 or 3 properties in that portfolio. And clearly, you're then going to enhance your return significantly compared to if you were just buying one. Now, I'm not saying that everyone should or can take out a mortgage, because not everyone can. I was reading an article actually yesterday in the FT basically saying that 20% of high net worths in the UK can't get mortgages because their investments aren't structured in a way that, you know, banks have this sort of tick box process that if you can't satisfy a certain question, even though you have more than enough income or capital, they won't lend to you. So it's not available to everyone. You might be at a certain age where you want to start reducing the debt, so I get that. But if you possibly can, the leverage is absolutely key. There are tax benefits to that. In many countries, you can still offset your interest against your income and pay less tax. Less so in the UK, but you can still do it. There's still a meaningful amount to do. It can have a beneficial effect on inheritance tax in some jurisdictions as well. So it's definitely worth looking at and definitely worth pursuing. And that's something as a business that we can advise on if you want to go down that route. Next slide, please.
Thanks, Johnny. So just jumping sort of onto important factors for international investment. I mean, we're a company that generally help investors. We do advise people in the UK, but a lot of our clients are overseas and then buying into another country, perhaps. So, you know, some of the things that people fall foul of is that first point. You know, can you own the title outright? Johnny mentioned you know you'd gone on holiday somewhere, it looked beautiful. It could be Sri Lanka or something like that, but you have to potentially sort of partner with a local, and that adds additional complications. So always important that you can make sure it's your title and you can do what you want with that title. We spoke about the impact, Johnny spoke about the impact of getting a mortgage. So can you know, if you can't get one there, that's looks like it reduces your returns dramatically, as we've shown. but also it might mean it's harder for you to exit that property because the next person buying that property may not be able to get a mortgage. So you've got less exits, you've got less buyers for that asset. Currency risk, you know, at the moment, currencies have been moving around a bit more than I remember sort of 10 or 15 years ago with everything that's going on. And that can very quickly go against you and wipe out returns. And certainly in sort of more of the sort of emerging markets that we were investing in sort of pre-2008 financial crisis. So very, very important that you consider where you sit with the currency risk. Language challenges on purchase can be very complicated. Understanding the contracts that you're signing, you know, very important stuff. And then of course the ongoing management of that property and the rental laws and collecting your rent and understanding what service charges you may have to pay. All these things can be a challenge when investing internationally. So all things that you should be considering how they're going to impact you long term. And then of course regulation. I mean, we're only interested in markets that are very strongly regulated, where you've got ownership, where there's regulation behind, for instance, the sort of service charges, the maintenance costs of buildings, and the tenancy rules, and where we don't expect any changes, where we don't suddenly expect the government to ban foreign ownership in certain areas or the banks to stop lending to certain nationalities. And these kind of challenges do exist. Johnny, anything to add to that?
Yeah, I mean, look, over the years, we've discovered this the hard way. I mean, if I think back to, when was this, 2006, 7, 8, when effectively we just started the business, and our view that many Western type economies were just too expensive. And that obviously sort of preceded the crash of 2008, 9, when actually asset prices came down significantly. So at that point in time, we were targeting commodity rich markets, emerging economies, and by nature, they were more speculative. And, you know, we did find out the hard way that in terms of the title, yes, there were ways to secure the title, but it was difficult. You did have to form local structures with local form local companies or partner, as Will said earlier. There can be and were language challenges. I remember we invested in Brazil. Gosh, when was that? 2007, 8. And actually invested it very well. Very helpfully, the real appreciated, you know, very strongly in line with the whole sort of commodity super cycle. But it was difficult to navigate through everything. All the contracts were written in Portuguese. And whilst we knew that at the time, the realities and the practicalities of dealing with that made us think, well, is that worth it next time? Not everyone has the appetite to sort of go through all of that. And I think, you know, the sort of general common sense, because so many markets that you deal with in countries, in parts of Southeast Asia, parts of Europe, there seems to be a two-tier system, one rule for locals and one rule for foreign investors and everywhere else. And, you know, that again is not a situation you want to be in. You want to have as much protection as you possibly can and be treated the same as everybody else, because at times of disputes, and these will happen from time to time, you know, you don't want to come worse off than anybody else. So therefore, I think, you know, ultimately you're keeping things simple in all of this. Next slide, please. So incentives, we see incentives a lot, and incentives to invest in properties do come in all sorts of shapes and sizes. They could come in the form of rental guarantees or discounts off the price or furniture packs, combination of all of that. And it's worth pointing out that sometimes, you know, genuine incentives do exist. I mean, as Will mentioned on our business model, I mean, we're essentially buying in bulk at the outset. We're adopting a sort of wholesale retail type model, and that does benefit us ultimately. I mean, sometimes we do get some decent discounts that we can pass on to clients that are below sort of retail value. We have a lettings company, for example, in the UK, and sometimes, you know, we can get on the front foot and have properties pre-let to local corporates to the extent that we can give rental guarantees to our clients. And these are genuine, but sometimes you'll see situations where you're buying a property and, you know, you'll be given a very high looking rental guarantee for a period of time. And you think, well, how does that work? Because the way to look at this is really understand what the market is providing, and then what the developer or the agent is providing. And if, I don't know, the agent is providing or the person that's selling to you is providing a 7-8% guarantee, but the market is only giving 4%, well, clearly there's something amiss there. And the other thing is that after the rental guarantee is finished, then you're back down to a level where your cash flow might be problematic for you. So you need to understand at the outset, you know, what it is that you're paying for. Has the price been moved up a couple of percentage points, 5 percentage points, whatever else, just to cover those incentives, or are they genuine? And only that will be found out by sort of doing genuine research into the market and talking to local agents and doing comparables, which are very easy to find. But make sure that you do dig and you do ask the question to whoever's selling the property, well, how is that? How has that come about? Just to make sure that it's not factored into the price. Anything on that, Will?
Yeah, I mean, that's a good point, Johnny. There can also be challenges around financing if a bank, for example, was to sort of look at the rental guarantee and then start value perhaps, and can give you some financial mortgage issues as well.
Yeah, banks don't like incentives. You know, if you're applying for a mortgage and then you start talking about rental guarantees or discounts or this, that and the other, then they'll start to look at things a little bit more closely. So again, you want to go in with your eyes open on that.
Yeah. And that slide ties in quite nicely to this. I mean, time and time again, Johnny, you know, we see people sort of looking to potentially make decisions based on a rent guarantee or something, and it looks very attractive. But when we've described on that leverage slide where you compared the cash purchase versus the leverage purchase, achieving growth on the property value is going to give you a far higher return, but also making sure that that asset is going to hold its value or, you know, or go up in value is equally important and potentially far more important. So I think this is a sort of interesting slide. I think clearly there is a drive for a little bit more yield at the moment. And we've seen yields compress in markets like London that we've been very active in and like Berlin, but there are reasons why investors would be prepared to invest into those cities and achieve a lower yield than buying in a city like Liverpool, for example, in the UK, or a city like Birmingham. You know, there are reasons why, and that is probably, if ultimately when you think about it, it's to do with security. You know, how secure is that value or that asset in a difficult time? And I can tell you one thing, that the better the quality of the property, the easier it is to rent, the easier it is to sell. And ultimately, we've seen that over the last sort of 12 months where we've had a very unexpected crisis. And, you know, hopefully we're nearly through that. But we've seen without doubt that the properties that are of better quality are still yielding at these times. So yields aren't everything. And I would encourage you to not make decisions based on the sort of potential short-term yield offerings that look very attractive.
Yeah, I think just to add to that, there's that sort of capital preservation play. People often ask me, you know, if you had £100,000 or £200,000 to invest in the UK, where would you invest? And, you know, the question that you then ask back is, well, you know, what's the driver here? Is it capital preservation? Is it yield? Or is it a combination of the two? Because typically your Londons of this world will be less affected by a deep recession than maybe the tier 2, tier 3 cities. But conversely, you know, those are the ones that would cash flow the best typically, because you're paying a lower ticket and getting a higher yield. So I guess, you know, ideally speaking, there's a combination of the two, but it's something you need to sort of factor in on both sides, I think.
Perfect.
Next slide, please. Yeah, profiteering, that's an interesting one. I mean, we see over the years some weird and wonderful ways, and I guess it's sort of vaguely tied to property as an asset class, which is why I thought it'd be important to bring this in. I mean, car park spaces have done the rounds over the years. Typically, they're the ones that are sort of based by airports. I've only actually seen them in the UK. They might have been in other countries, but ultimately you're buying a bit of a field in a close-ish to an airport somewhere in the UK, apparently, that will give you a very good yield for a period of time. Student pods are another one, and student accommodation is something that that we've been close to for the last 7 or 8 years within the business. But I hasten to add, structuring it in a very different way. These student pods typically are comprised of buildings that are student halls or built student halls, but what you're able to do is buy a single room rather than a whole building. And the ticket price is low. I mean, typically you're buying something for £60,000–70,000, so the ticket price is low. But what's attractive is potentially the yield. These companies are offering extended periods of time, up to 10 years of sort of 8–10%. And the problem there is, well, there's two problems. And that goes with the car parking spaces and the apart hotels as well, which are a combination of apartments and a hotel that you're buying a piece of a hotel, basically a hotel room. And all of these share the same commonalities. One, when you buy these properties, you can't sell them because there's not really a market. You can't get a mortgage on this. You have to pay cash. So immediately you're limiting the pool of people that can afford or are able to buy these types of property. So liquidity is a real issue. And two, these rental guarantees very often just don't stack up. And if you look at these, I mean, the whole purchasing process, you're actually dealing with two different companies. You're dealing with company A that's selling the product and company B that's offering the rental guarantee. And the problem is, and I've seen this several times, is that company B might pay your rental return for 2–3 years, and then for whatever reason that just disappears, or they go bust, or they say that the costs have increased so they can't afford to pay the original amount promised. And there's nothing that you can do because contractually there's very little in place and there's very little protection. So I would absolutely, how can I put it, warn people to avoid these types of products unless you can see right through as to how the holding structure is. Can you get a mortgage? Is there true liquidity? Because very often these products get striped up in price just because, or just so that they can pay a healthy rental guarantee in inverted commas, which then dries up after 2 years, and you're left with nothing. You're left with a useless asset which can't be rented and can't be sold on. I do think there has been more regulation come into play over the last year or so. I haven't seen so many of these things about, but do be warned, they're still around. Very often you might get a sort of unsolicited email, but don't touch them is my advice. Next slide, please.
Okay, so you're beginning to understand what you want to buy and where you want to buy, and for the right reasons. So you've got to start looking at what the payment structures are and making sure you fully understand the costs and the risks. So I think from our side, we're always looking to invest in a project that is under construction, because that's when we can get the best value. But you want to be making sure that you're only putting in, a sensible deposit. You want to make sure the developer has the funding to build the scheme and isn't just using the investor's money to get the project through to completion. Everything in the UK that we do, we have insurance in place on part of the deposit. Typically, it's 10% of the purchase price. So, you should be asking for a copy of that policy from your lawyer before you exchange, and understanding how that policy protects you. That policy is typically paid for by the developer, put in place by the developer. We provide detailed cash flows on every unit that we bring to market, which show you all of your legal fees, give you accurate estimates on your mortgage fees, a clear breakdown of how the service charge will be portioned throughout the building, and what your contribution is. So you know, all of these things, if somebody isn't giving you these answers, then, you know, you need to make sure you find a company that will give you these answers. But yeah, key slide, make sure you fully understand the risks, the payment structures and the costs.
Yeah, I think just to add to that, Will, I mean, you say if people aren't giving you the answers, I mean, that implies that you know the right questions to ask, and that's not always the case. Because if you're dealing with transactions in countries that you're not from, you might not be aware of some of the costs that come into play. I mean, to be honest, some of the costs in, say, Portugal or Germany are higher than, the transaction costs, I should say, are higher than maybe investors are used to in the UK or Hong Kong or Singapore. I mean, there is a reason for that. But the question is, well, the point here is, you know, are you aware at the outset? Because a lot of this is cash outlay. So a property that you're going to buy for, if you'd earmarked maybe a budget for $300,000 or $400,000 US, you've then got to factor in the transaction costs, which will be part of the cash component. So that may mean that actually you could only afford to buy something that's $300,000 or $350,000 US. So it's very important to, as Will says, work with a business that is transparent at the outset, and say, right, these are your closing costs. This is where these costs go. These are the negotiables. These are the non-negotiables. So that people can go in with their eyes open, because the last thing you want to do is you know, face at the point of completion where you are committed to buying the property. You then have an extra, I don't know, 5% stamp duty that you didn't think you were going to have to account for, and you've got to find the money from somewhere. So it's very important to have this all sort of stacked up from the very beginning, I think. And you know, we do our best to do that, but again, you do hear of situations where people get caught out. The other point I just wanted to talk about was the deposits. I mean, that's a really important factor, because you know, that's gained sort of notoriety in some of the press over recent years, certainly as far as buying properties in the UK and elsewhere, actually, because what developers sometimes do, if they're not well capitalized, is actually use the deposits that you're paying to fund the build. And you don't want to touch any developments that are doing that. You want to be absolutely sure from the outset that the developer has the construction finance. You want to see evidence of that through your agent or through your counterparty that you're dealing with, so that your deposit is not being used to fund the build. Because, you know, what happens if the developer then runs out of money? Your deposit is going to be lost. It's not protected. So you want to be absolutely sure that A, you're putting down a smaller deposit as possible, ideally, which is best for your cash flow, and B, any deposit that you do put down is adequately protected, because you never know what's going to happen, and you want to make absolutely sure that the protection is there in place if you need it.
Thanks, Johnny.
Yeah, I think this is me. So liquidity and exit strategy. I mean, I always say that before you buy a property or indeed any investment, you've got to know how you're going to sell it, if it is for investment purposes, because by nature, you'll want to access that money at a point, you know, in time to reinvest in something else or buy the house of your dreams or whatever else. But you've got to make sure you can sell it. And that comes down as a function to supply and demand. You know, if you're buying into an area that has too much supply, then you're not going to be able to sell it particularly easy. I mean, this is back to what Will was saying in an earlier slide. You've got to be sure that there's demand on the local market as well. It's no good buying into areas where it's just full of you know, buy-to-let investors, because typically buy-to-let people probably all want to sell at the same time as well, just to sort of time the market cycle. So you want to go into a market that does have a good diversity of, you know, owner-occupiers, people that live there, and also buy-to-let investors. Invariably, they're everywhere. Availability of mortgages is key as well, because if you're investing in a market where mortgages aren't particularly well available and you have to buy cash all the time, again, that reduces your pool of potential people that are going to buy on exit, and, you know, reduce the liquidity there, which is not what you want to do. the foreign restrictions that do exist in some of these markets. For example, in Australia, foreigners can only buy new build, they can't buy second-hand properties. In Thailand as well, there are restrictions in place, you know, percentage of foreigners within a condo complex, and only a certain type of title in land, if you are able to buy land in maybe some of the islands in Phuket and Samui. So you've got to make sure that whatever you buy can appeal to the masses rather than either locals or foreigners. You ideally want a combination of the two. And lastly, just be aware of any sort of potential legislative changes that may happen that will affect liquidity further down the line. Typically, you know, I've got nothing against resort type properties. I mean, I keep talking about that. And if you go in with the idea that it is a lifestyle type play rather than an investment, and you're going to use that and enjoy it, then that's fine. But typically, if you do buy in these countries, sometimes legislation does change. I mean, I remember it changed quite significantly in Sri Lanka a couple of years ago, which really did change things for foreign investors and what they couldn't buy in the secondary market. So you don't want to be caught out with that. And again, you want to do your research, look what's happened historically, and just have your finger on the pulse as to what may happen going forward. But ultimately, again, it pays, I think, to stick to countries that have this sort of legal framework that has remained pretty static over the years and hopefully isn't going to change anytime soon.
So just to finish, I mean, we've talked about mortgages, we've talked about maximizing your returns. So it's just also understanding when you're getting into an investment, which banks are lending, which banks have been in the market for a number of years. Some banks do come and some banks do leave these kind of expat international markets. What documentation does the bank require? If you're self-employed, you really do need to understand what documentation you need to supply, because it may be very challenging if you're self-employed to get a mortgage, rightly or wrongly. Is there any valuation risk behind here? The bank normally do a valuation, so you need to make sure the property is you need to ultimately make the right decisions and buy the right property for the right price, which is clearly where we can add a lot of value. You've got changing circumstances. In some markets, for example, in the UK, you secure your mortgage sort of when the building is finished. And we're dealing with projects that are 1 or 2 years away from completion from time to time. In other markets like Germany, we deal with the same kind of properties. They're 1 or 2 years away from completion, but you're able to secure your mortgage right at the beginning and protect yourself. So those markets may be of more interest to some people than others, depending on if they know where they're going to be in 1 or 2 years' time and what they're going to be doing. So really just that little bit of comments on mortgages before we finish off and take some questions from our audience.
Yeah, I see we've got a few questions. Just to add to that, I mean, mortgages are straightforward still, but they're not as straightforward as they were. I think that's a reasonable summary of the sort of state of play of the market. And you absolutely do need to take advice from a mortgage broker before you commit to something. I mean, you need to know and have as much security as you can to know that you're going to get a mortgage, is what I would say. You don't want to commit funds and unless you are reasonably comfortable on that. You know, you sometimes do get the sort of vagaries and nuances of banks coming through. For example, some banks may, as a matter of course, downvalue new builds, which is really annoying, but that's just what they do sometimes. So again, you've got to factor that in, and we'll advise people that may be imminent, and ideally speaking, we would choose those banks that would not sort of automatically downvalue new builds. The other thing is just to make sure and ensure that whatever you're investing in does have that element of owner occupiers in, because again, certainly banks in the UK won't lend to buildings that have, you know, 100% of buy-to-let investors. You can understand why as well. And as a business, clearly, you know, we're looking to offer as much protection as possible to our investors. So clearly we will market to owner occupiers and have a percentage of the units allocated for that, but not everyone does. So again, these are questions to ask. They might not be the obvious questions, but these are questions to ask at the outset before you sort of go too far down the line. Now, in terms of questions and answers, how are we going to do this? Because I can see the Q&A here. Will, do you want to sort of alternate between the two? Do you want to do it, Nicola, or?
Hi everyone. I will select, we've got loads of questions, so I'll select a couple of the key ones that we can,
Perfect.
that we have enough time for, if you're okay with that.
Perfect.
Great. All right, so the first question we have is, do you see demand increase in city outskirts and towns given the trend post-COVID of people valuing more open green spaces and working from home?
Will, do you want to go for that one?
Yeah, I think it's a very good question. I guess it depends, I think slightly depends on whether you think that we're going to get through this pandemic and life's going to return to normal, because I'm confident that we will. And I think that means that potentially, buying in city centres now is a very sensible thing to do, because some people are not doing that. And we've seen a lot of investment pouring into the sort of home counties around London, for example, and that London money has significantly pushed up values in some of these areas. And I think that is actually a bit of a short-term boom that we're seeing. And I think that those markets could rise a bit too dramatically, and there could be some value on offering in investing in what other people perhaps aren't all investing in right now. So just a thought on that question, Johnny. I'm not sure if there's anything else to add on that.
Yeah, I think it's made people reassess what they're looking for in terms of where they want to live. I don't think this is the sort of death of cities, as it was sort of feared maybe 6 months ago that London and Manchester and Birmingham and Hong Kong and Singapore were just sort of tumbleweeds going through these deserted areas, because that's not happened. And I think all this COVID episode has done is really sort of speed up the inevitable, that there was a sort of push to remote working that was probably going to take 5-10 years maybe just to get to the level it is now, and that was dramatically accelerated over the last sort of 12 months. And I think we're going to reach a sort of happy medium where people do understand that they don't need to be in the office all of the time. Employers are happy to accommodate this. Maybe they'll downsize some of their office space, but there's still an absolute need for human beings. We're sociable creatures. We want to be in areas, certainly work environments, where there are other people. So in the most case, I think there will be a combination of the two, and therefore people can afford to travel a bit further if it's only for 2 or 3 days a week, and therefore that's sort of buoyed up the markets for these commuter areas. But that said, there will be people that always want to live in cities as well. So I think it's just opened people's eyes a bit, that there's a choice out there, rather than before it was either you live 5 minutes away from the office or as close as you could, and that was it.
Fantastic, thanks. The next question we have is, you mentioned that most of IPG's projects are off plan. What's the benefit of that? Because I'm worried it won't get built, especially given COVID and the delays.
Yeah, again, I think it depends on what markets that you operate in, and what the incentives are for developers to build. So, for example, in the UK and Germany, well, certainly let's start with Germany. They have to start compensating investors if they go past a certain point of delay. So clearly there's a massive reason not to stray too much from the original completion date. In Portugal, there's also something similar in place there as well. In the UK, we have something called a long stop date, typically written into a contract. So if it goes beyond a certain date, then investors have the opportunity to pull their funds out of the investment. So there is protection there. Clearly, no one wants to have to exercise those options, but there's protection. That's the key thing. And yes, COVID has affected things, no question, over the last sort of 12 months. There has been slippage in many projects that I can think of. Not significant, but definitely slippage. Both from a development point of view and also from a legal perspective as well. I mean, everyone's had their challenges, so things have taken longer than they should have done. But ultimately, my advice would be only to invest in markets where there is that protection in place and that transparency.
Yeah, and on slippage, John, I mean, it's important to note that, because we're all around the world in different places today, that in our core markets, sort of UK, Germany, and Portugal, construction wasn't one of the restricted industries. So although, of course, you know, less people on site was probably key, we have still seen the industry move ahead. We have still seen, just thinking now about 3 projects we've had completed in the last 12 months, which we've managed to get through completions and then start to get tenants in. So, you know, things are, we're all working much harder to get to those results, but it hasn't been, you know, the market is actually looking pretty strong at the moment, especially the activity in terms of buying as well. Buying and selling in most markets is very strong.
Great. And following on from that, don't you find the yields are getting perhaps smaller in the UK and Europe, and why not focus on Asia?
Johnny?
Okay, why not focus on Asia? Just to answer that question backwards, we're constantly looking at Asia. I mean, we're a Hong Kong-based business, so, you know, Asia's on our doorstep, literally. Again, the challenge with Asia is that many of the economies that we would want to invest in do have restrictions in place for foreign investors. There have been cities in India that we've looked at over the years, but they're not, unless you're resident of India or have an Indian passport, you simply can't do that. Same with China as well. China wasn't a straightforward place to invest. But clearly those that were able in places like Shanghai, Beijing, and virtually every city in China over the last 10 years, the returns have been extremely good. So our challenge, I think, with most Asian countries, Southeast Asian countries, has been the legislation and the rules for foreign investors. It's just not straightforward. So therefore, you know, we have typically stuck to Western type economies. Australia is probably the exception to that. We did a lot of work in Australia sort of 5-6 years ago, but typically US, UK, Europe has been our sort of mainstay for the last 10 years or so. Sorry, what was the first part of that question, Nicola?
Don't you find that yields are getting smaller in Europe and the UK?
Yes and no, it depends. It depends where you look at. I do think there's that sort of trade-off, as I mentioned earlier, between the larger cities and the secondary, tertiary cities as far as yield is concerned. Typically, you will get higher yields in those types of secondary, tertiary cities. But yeah, definitely there's been a squeeze as far as the primary tier 1 cities, the capital cities is concerned. You know, places like London, Berlin, Dublin, that's been squeezed as well since we invested there 2 or 3 years ago. So yeah, you do have to work hard to find the cash flow, but then there are some that want to invest as purely a capital protection player and a capital growth play and are happy to forego a bit of yield as a result.
Great. All right. And how do you decide if it's best to get a mortgage in your home country or in the country of your investment?
I'm happy to pick that one up, Johnny, and give you a break. I think there's some considerations there. I think the one thing I would think about there is what currency are you locally looking to maybe borrow, and what currency are you looking to buy the property in? Because today it might make sense to borrow, for example, dollars and then buy the property in pounds. But in years to come, the dollar may weaken and the pound may strengthen, or the other way around, which then hurts. The other way around, it then hurts you. So I think you've just got to be careful that you don't end up in a situation where you're literally going to bed at night wondering how much money it's actually going to cost you to pay your mortgage tomorrow. And we have seen that in the past. Those sort of dollar loans have been available in, I think perhaps in Asia, and it's certainly in I know in Kazakhstan and Russia and these kind of places. So I think our advice would be keep it simple, borrow where you're going to buy in that jurisdiction. I think that would be IP Global's strong advice there. Yeah,
definitely. And I don't think these days you have a huge amount of choice, because the banks also don't want to take too much risk, and they would much rather lend in the currency of the asset that you're buying in.
Fantastic. All right. I think in terms of time, let's grab one more question. So you're suggesting focusing on capital appreciation over yield, but does this not open ourselves to a larger capital gains tax burden?
We're not suggesting that. We're suggesting that it really depends on an individual's preference, what they're targeting. And yes, you make more money and you pay more tax, but I guess that's a nice problem to have. You know, you're only paying tax if you're making a profit. And then look, in some of these countries, you know, the tax is better than others. You hold an asset in Germany, for example, in Berlin for 10 years or more, you don't pay any profits tax, for example. So there are ways and means around this in legal terms, or on a legal basis. You can minimize the tax that you're going to pay here. Again, you've just got to do your research beforehand and really understand what the markets are.
Fantastic. Thank you.
I did see another question as well, just to answer. We are sending out the, we will send out the deck to anyone that's interested, won't we, Nicola?
Yes, absolutely. And we will get to all of your questions at a later date. We just won't get to them in the presentation, unfortunately. But thank you all so much for joining us. And yeah, JG and Will, do you have any closing comments?
No, thank you for joining us. We've got more webinars coming up, so do keep an eye on our website and feel free to reach out to any of us if you have any questions. We can speak again. So thank you for everyone's time.
Yeah,
Yes.
Thank you very much indeed.
Fantastic. Thanks, everyone. Bye.
Bye-bye.